Have you ever checked your credit score and wondered, is it good enough to buy my dream home? Let's be real. Your credit score can feel like a mystery, but it's one of the biggest factors in qualifying for a mortgage and getting a great rate. The good news. There are simple steps you can take right now to give your score a healthy boost before you start house hunting. I'm here with 5 tips to help you improve your credit score before buying a home. First, check for errors. It sounds simple, but checking your credit report for mistakes or outdated info is key. And don't worry, you can do this for free. Multiple times per year, the Fair Credit Reporting Act gives you the right to get a free copy of your credit report from each of the major credit bureaus, TransUnion, Equifax, and Experian. You can get your reports for free at annualkreditrapport.com, the official site for free credit reports. Look for any errors and dispute them. Late payments, charge-offs, bankruptcies, foreclosures, and liens will all negatively impact your credit score. So you want to make sure these are only on your report if they're accurate. Outdated negative items can also hurt your score, and those can be removed after a certain period of time depending on the type of item. For example, most late payments will fall off your credit report after 7 years. Charge-offs, bankruptcies, and foreclosures remain on your report for 7 to 10 years, and closed accounts stay for up to 10 years. If you find any errors or negative items that have been on your report for longer than they should, contact the credit bureau directly and ask for an investigation. Include documentation like a copy of your rent receipt if you know that a late payment was wrongly reported. Providing documentation can help speed up the process. Be persistent, because fixing errors can quickly raise your credit score. Second, pay down credit cards. Credit card debt is one of the easiest ways to build up a negative credit history. That's because credit card companies report missed or late payments to the credit bureaus, which hurts your credit score. Plus, your credit utilization ratio, also known as credit usage, makes up a big chunk of your credit score. This is the amount of credit that you're currently using compared to your total available credit. Lenders like to see that you're using less than 30% of your overall credit limit. And if you have multiple credit cards, this calculation is done separately for each card and then averaged. So say you have 2 credit cards, one with a balance of $200 on a $1,000 limit and another with a balance of $750 on a $1,000 limit. Your credit utilization ratios would be 20% and 75% respectively. These would average to 47.5%, which could hurt your credit score. The best way to avoid high credit utilization ratios is to pay the full balance down below 30 of your limit before the billing cycle closes on each card. Doing this each month is ideal, but paying them down below 30 before the end of the month can also make a difference. If you can't pay them down below 30 each month, aim to at least pay them down below 9%. This can keep your credit utilization ratios low enough to avoid hurting your score. And remember, credit utilization ratios are calculated separately for each card and then averaged. So if one of your cards has a balance above 30%, focus on bringing it down below 30 while keeping the rest below 9%. It may seem impossible to pay down so much debt, but making just a few small changes to your monthly budget can make a big difference. Consider cutting back on non-essential expenses like eating out or subscriptions and put that money toward paying down your credit card balances. You might be surprised by how quickly your score can go up. Third, don't open new accounts. When you apply for new credit, lenders will perform a hard inquiry or hard pull on your credit report. This can temporarily lower your credit score by a few points, and multiple inquiries in a short period can really add up. For instance, if you're trying to qualify for an auto loan and a credit card at the same time, 2 hard pulls could drop your score by 10 points or more. Lenders use hard pulls to assess your creditworthiness. They want to know if you've managed your finances responsibly in the past. They also want to make sure that you will be able to handle the responsibility of a new credit account. Hard pulls stay on your credit report for 2 years, but they only have a temporary effect on your score. Once they start to fade away after 2 years, you can start trying to open new accounts again. You can also minimize the effects of hard pulls by applying for credit at the same time. That is because lenders typically only count the first hard pull when multiple applications come within a short period of time. This is known as a group inquiry or a trade line, and it stays on your credit report for 2 years, just like a hard pull. A trade line won't hurt your score forever, but it can temporarily lower it. Applying for a mortgage is a bit different. Instead of a hard pull, lenders will perform a soft credit pull when you apply for a mortgage. This doesn't affect your credit score, and there's no need to wait to apply. You are pre-approved for a mortgage once the lender has completed a soft credit pull and you meet their lending criteria. However, once you're pre-approved and you move forward with the application process, the lender will run a hard pull to finalize your approval. Once you're approved, your credit score will be locked in and won't change unless there are additional changes to your credit history. So hold off on opening new accounts and applying for new credit until after you close on your home to avoid any unnecessary risk to your score. Fourth, make payments on time. Late payments can seriously damage your credit score and your wallet. One late payment can reduce your score by 100 points or more, and most mortgages require you to have a minimum credit score of 620 to qualify for their best rates. So you can see how a late payment could push you over the edge and cost you thousands in the long run. That's why it's important to make your payments on time every month. Setting reminders on your calendar or using autopay can help you stay on track. But if you do happen to be late, contact your creditor right away to let them know. Most will forgive late fees if you call and explain your situation. Some creditors even allow you to waive late fees if you have never been late before and have a good payment history. Fifth, keep old accounts open. In addition to your payment history, the length of your credit history is another major factor in determining your credit score. The average age of your credit history is calculated by taking the age of your oldest account, adding the age of your newest account, and then dividing by the number of accounts used to calculate your average. If you have an old credit card or loan that you aren't using anymore, consider keeping it open. Closing an account will remove it from your credit history and lower the average age of your credit history. If you have to close an account due to inactivity or high annual fees, request that your account be closed in good standing. That way, it will remain on your credit report and be marked as paid in full. Keeping old accounts open can give you a significant boost in your credit score because it increases the age of your credit history. And before we go, here's a quick bonus tip. Did you know that you can ask your mortgage broker about increasing your credit score during the loan approval process through something called Rapid Rescore? This is when you make a large payment on your credit card or other debt with the goal of lowering your credit utilization ratio. By asking for a rapid rescore, you are telling the lender that you will pay the balance down before closing and they'll take your word for it. If you're planning to close soon, this can save you from going through the entire underwriting process with a higher interest rate. Improving your credit score doesn't happen overnight, but even small changes can make a big difference. Now that you know how to improve your credit score, it's time to start thinking about buying a home. Be sure to subscribe to our channel for more home buying tips.